We are back now with breaking jobs data.
Yeah, the U.S. economy added 223,000 jobs in December. That's more than expected, while the unemployment rate dipped slightly to 3.5%.
To help us delve into all this, we're joined by NBC News business and data reporter Brian Cheung and Investopedia's editor-in-chief Caleb Silver. Good morning to both of you. So, Brian, first of all, just walk us through this latest report. What does it show?
Yeah, well, it tells us broadly that the labor market in the United States still looks very strong. In November, we added about 263,000 jobs. In the month of December, we added 223,000 jobs. And by the way, that was a bigger beat than what Wall Street had expected. They were expecting maybe only about 200,000 jobs in this particular report. The unemployment rate, also importantly, ticking down to 3.5%. It was 3.7% in the last report. So some nice gains there. A lot of that driven by leisure and hospitality. But overall, it seems like a good report.
Caleb, what's your immediate reaction to these numbers?
Well, the job gains are where the job gains have been for the past 11 months. The services part of the economy, leisure and hospitality, Brian mentioned it, bars and restaurants still can't get enough workers. You're also seeing it in professional services where you're seeing lawyers, accountants, even repair folks seeing more and more job gains. But we are seeing some job losses in big tech that did not show up here. In just the last few days, we've heard of big layoffs at companies like Salesforce, Amazon, and we're going to continue to hear that going into the year. This just caps off a very strong year of job gains, though.
But that's the big question. If January is going to be a very sudden change, right?
Yeah, we could easily see that. And I think it's because the economy is softening a little bit. And as these interest rates continue to increase, and the Fed's going to continue to increase rates at least 2 more times this year, you're going to see more layoffs, especially in tech and those growth companies that just have to deal with those tighter profit margins right now.
Brian, you mentioned leisure and hospitality. Let's break it down more. Which sectors are seeing the biggest job gains and the biggest losses?
Yeah, so leisure and hospitality, which is bars and restaurants, that added about 67,000 jobs in the month of December. That was the big driver for the gains that we had seen. But Caleb was just mentioning professional and business services. This is kind of the bucket where you would see some of those tech jobs, not all of them. Some of them are bucketed into communications if it's, let's say, for example, Meta. But that actually contracted by about 6,000 in the month of December. So that's certainly not a good thing, but not affecting the overall picture. But one last thing I want to mention here is real estate. We've seen a lot of changes in the real estate sector, a lot of mortgage brokers and a lot of realtors finding difficulty getting jobs right now with that high mortgage rate. So that actually added only about 7,000 jobs in the month of December. We did see contractions in other industries as well. I'm looking at state government, education, and also, interestingly, employment services. So it seems like a lot of employers not seeking out third-party providers to help them find other workers. Maybe that's a leading indicator for not as strong job gains in future months.
Caleb, let's talk interest rates right now. The Fed's target interest rate for 2023 is 5.1%. How does potentially the job market staying strong impact that, or does it?
Well, the Fed actually, believe it or not, wants the unemployment rate to go up a little bit, and it wants wage growth to cool down. And this is the first time we've seen this just in the last month. Wage gains were up about 9 cents, 4.6% on an annual rate. That's down from 5% that we saw in November. So the Fed wants to slow wage gains because wage inflation puts pressure on companies. They're going to see this and say that's working, but they're still probably going to raise rates at least 2 more times into 2023 to cool down inflation, which is far away from its 2% target.
So, Brian, if rates remain higher, what are the implications for Americans, especially if they remain higher for a longer period of time?
Yeah, well, it could mean, as Caleb was just talking about, that wage growth could slow down even further. As you mentioned, 5.1% was the yearly pace that we saw in November, ticked down to 4.6%. And by the way, these are lower numbers than the pace of inflation. So your wage gains are not keeping up with how much faster everything else is getting more expensive. But broadly speaking, there is the concern that that 3.5% unemployment rate, which, by the way, prior to 2022, we had not seen since 1969. That's really important to remember. Does that tick up? Could people lose their jobs? It's not happening in this December report, but maybe that is to come later on this year as the Fed continues to hike rates.
Caleb, to pick up on what you were just saying a minute ago, which I think might be kind of confusing for some people at home to understand, why would we want things to cool? Can you explain why having that weaker jobs market is better in some ways than having high inflation?
Yeah, so the Fed has basically said there's a choice out there. You can have high inflation or you can have high interest rates. High inflation hurts lower income people the most. Why? Because we've seen inflation in rent and food. You can't avoid those costs. So it hurts lower income folks the most. And they say higher interest rates are better. And that means cooling the economy, cooling hiring, and cooling wage growth. And all those things are starting to happen.
All right, Caleb and Brian, thank you for walking us through this on This Breaking News.
Thanks for watching our YouTube channel. Follow today's top stories and breaking news by downloading the NBC News app.